Welcome, everyone. Strong Valley, Monthly Market Matters. I'm Jason Rankin. I'm joined with my colleague, Chris Connor. Last time, if you caught the last month's update, you saw Adam Tirpelli, Kyle Triple there. They're not joining us on this one. We're going to take turns giving you guys updates and information. Chris, I'll let you kind of lead off on the fun September that we just got to go through.
That was not so fun. I would categorize it as not so fun. One of the worst is never fun. So, would we say roughly down about 10?
All major markets were down right around 10%, and that put it. I remember I was looking at the data going back for the last 20, 25 years, and I think it was. I mean, it was well within the top 10. It might have been the top 5. So it was definitely a tough month for all of us, advisors, clients. It was not a fun month.
We should probably preface that by saying this is for general information only, and you make sure to speak with us directly for information specific to your situation. That's sort of the kickoff disclaimer, right?
Absolutely.
Yeah,
absolutely. Everyone's situation is different, depending upon ages and goals and timelines. But there was nothing much that worked last month, and so we all felt it. Definitely wasn't fun, and I know a lot of it was driven. A lot of it was driven by Jerome Powell's words, head of the Fed. I think the intent there is that they're going to have to be more aggressive with interest rates to really try to get a hold of this inflation, and that was the market reacting to thinking, okay, we're not done with this rate hike. I think people thought there might have been 2, and now the expectation is that there's going to be 3.
Yeah, I think they want to get to somewhere between 4.25 and 4.5 by the end of the year, and we're in that 3 to 3.25% range right now for Fed funds rate, and so that's probably at least 2 more raises, like you said, maybe 3 by the end of this year, which is, again, as inflation continues to be headline news. The only way that they're really trying to combat it right now, they're not trying to cut spending on the fiscal side. They're just trying to raise interest rates and sort of, stop economic activity and slow it down tremendously. And I don't know how much you've talked recently to friends in the mortgage space or any of theirs. It's gotten slow, really slow for them. And that's housing slowing down as far as purchase prices go. And just
the refinances are gone. Yeah, so no one's refined. So really, you're just. I mean, the whole mortgage market is just someone that needs to relocate or wants to sell or wants to move. So I would imagine,
or has to
move.
Yeah,
so definitely slowing down
for sellers. Yeah, and we say it all the time. There's not always buyers. There are always sellers. They're not always buyers. And so if you just anecdotally go on to Zillow and look around your neighborhood or pick a neighborhood somewhere, you're more likely to see prices coming down, and reductions. And that's, again, we've talked about this in past calls too. That's a good indicator that inflation's likely to slow pretty quickly, because housing represents, we could argue, somewhere between 35 and 45% of consumer price index. And if that's their target, and you slow housing down, forget about, making it go backwards, but just slow it down. That's going to go a long ways towards their target.
And I feel this is, this is the absolute utmost concern to investors and to the market and to everybody, and it will be until it isn't. And it's not that I don't think investors are looking for inflation to dramatically drop. They just want to see it stop going up and just see it plateau. And the moment we can get that, under our belt, then I'm sure we'll go on to worry about the next thing. But right now, that's definitely what everyone is focused on. And that inflation report, for those that aren't familiar, that gets reprinted every month, right around the middle of the month, 13th, 14th, 15th, right around there. And so we'll get new inflation numbers again upcoming here in just a couple of weeks. And if that number is flat or down, then I would imagine you're going to see some optimism return, because that means the Federal Reserve can finally slow down on their future rate hikes. So that's something we'll be watching as well.
Yeah, and there really is a lot in terms of capital markets, equity markets, and fixed income markets. There's a lot of fear right now. I mean, these are times where there's not a lot of people interested in putting money to work, because the perception is that markets are going to be lower. And if we, I think, did you have something?
Yeah, good segue. I've got a chart I'm going to show up really quick talking about how strong the fear is right now. And I think part of the reason why people are so pessimistic, and so I've got a chart here on sentiment, people's feelings, emotions, and the term we use is called bearish for people that are not optimistic about what's going on. And I think a lot of this is dealt to people's feelings just because of the duration. Even the crash of COVID a couple of years ago, all of that happened in a matter of like 3 weeks. And 3 weeks later, we're already climbing out of it. Here we are, what feels like an eternity, but we're going on now basically into our 10th month. And I think we may have only had one positive month this year in early summer. And so people are definitely getting beaten up and getting tired of it. And they're having difficulty staying the course and seeing the long term of this. So what you're looking at here, these are sentiment ratings going back. Oh, this is more than 30 years of data here, going all the way back to 1987. And so the pessimism right now, you can see the extreme fearful. We're at a -43. And the only other 2 times in the last 30 some odd years that this has been worse was the recession of 1990. And that was right around the bottom of the market. And not to say that we're there now, but what feels like we could be close. And then the other time was in March of 2009. Which was also the bottom of the financial crisis. And so people are definitely getting scared. They're definitely getting worried. And we show here that in the past, when people have been this pessimistic and they're starting to capitulate, that gives us optimism that we could be nearing a bottom.
Yeah, and we won't know until time passes, and
we know.
You look back and you go, oh, that was the bottom there, and yeah, so that's something to look forward to.
Well, and I've got one other item that I'm going to show, because a lot of other conversations around when the market sells off like this is people are trying to anticipate, and the $1 million question is, how much of the cake is baked? We kind of have an idea of where inflation is now. We kind of have an idea of what the government's going to do with rates, and so the stock market is already pricing a lot of that expectation in. But then we'll get conversations too by clients saying, well, what if we go through a recession? What if we're in a recession? What if? And trying to time around it. Should we get out, wait for the recession to happen, and then get back in? And so what you're looking at here are recessions that we've had in this country going back to World War II. And it shows here that most of the pain that we have to go through, part of the heat in the kitchen, if you will, the price of admission of being an investor, most of the pain surrounding recessions is 6 months prior to the recession.
Sure.
There are some extreme cases while during the recession, we've seen some pain, but for the most part, during the recession itself, the market is positive. Most of the pain occurs beforehand. So trying to anticipate it and then waiting for the all coast is clear, you probably already missed the bottom.
Well, and the market is a leading indicator. So it's a predictor of what's coming, right? It's supposed to be, you're supposed to be discounting future profits, and I don't know how else to put it, but it's very difficult to predict a predictor. That's really difficult to get in front of. And the most successful people that we have to look around and sort of mimic in terms of how we invest and discipline, those people don't do it. Warren Buffett is not a market timer guy, and that's, he's one of the best to ever do it. And so it's important that the discipline continues in terms of staying invested and finding opportunities, because you're gonna find really good opportunities in times like that we're in right now, to either put cash to work. You may want to talk a little bit about money rates and CD rates and things like that. Put cash to work and find opportunities in sort of the broken stack, where you go in and find companies or sectors or parts of the market that have been just absolutely thrown away that have massive value, built into them. And I don't know if we want to do much of that on this call. I mean, the reminder here, Monthly Market Matters is supposed to be pretty short format, right? 2 of us just get on, but also we may want to talk about things that we're going to introduce on some of our future calls too. So I don't know, you want to pick one of those to go
one I do want to mention, because this is one thing that we have not had available to us in probably better part of a decade. When we talk about all this fear of rising rates, that's definitely going to add pressure to anyone that's looking to buy a home, borrow money, get a loan, things like that. And that's definitely going to be hard on that part of the country. But but the kind of the back end silver lining to rates going up is people that have money. Majority of our clients that have cash are sitting on something that they're now going to be offered better interest, whether it's a money market. I think most of our money market rates now that we've got access to are flirting with 3%, I believe, and then now into CDs and things like that. And so there's actually some attractive rates, which haven't been there in I can't remember how long, but that's at least one opportunity that's starting to show itself now.
Well, the answer to your question is how long it's been. So the Fed started really lowering rates. They raised going 2006 to 2007. And then, of course, financial crisis started and they dropped the rates effectively to zero. And that's the last time. So 08, 09 was when we saw, really attractive money market and CD and short-term bond rates. So it's been, let's call it 12, 13 years since we've been able to, tell clients that we're getting north of 4 tax equivalent, let's say on money markets. So that's, some of that stuff is still going to come through as they continue to raise rates. It's a reward for lenders, right? And that's, we talk about this with folks all the time. If you have money to lend, invest, buy, that you don't want to take a lot of risk with, there are really good places to put that right now, and be able to earn a reasonable return. I mean, if we argue that inflation's 8 or 9 for this year, you're not going to get that in CDs and money markets, no question. But you have to have some safe money anyway, and you might as well, make it work for you. So that's something that's interesting also. So what do you have coming up in October? Just a short list of things. Some of it, again, that we're going to send out through social media or do additional video pieces on.
Yeah, we've got quite a few other items coming out. That's why I want to remind people too. If you're listening to us for the first time, you can continue to follow us on YouTube. We've got a podcast available wherever you get your podcasts. But we've got quite a few pieces coming up now heading into the fourth quarter. If you want to lay it out, Chris.
Yeah. So a couple things, investing in things that matter and make a difference. So just theme wise, sort of feel good investments and places that can certainly make you money, but are something that aligned with the way you think philosophically. And some of that bleeds into the second item, which is charitable giving. So this time every year, we start to get into tax planning season and things that we need to do by year end, whether that's tax loss swaps or things of that nature, but also folks that want to do some philanthropic giving, and the right ways to do that, whether it's donor advised funds or direct gifts of stock. There are plenty of gains that are still in portfolios. We haven't seen any of the sort of long-term negative rates that would take all that out. We have lots of gains that are still embedded. And so if you're, for those folks that want to be giving at year end, there are really tax effective ways to do that, and ways that you can sort of maintain control and still be making gifts at the same time. So I think some of that stuff's coming up.
I think with those gifts, and what we're going to try to explain, there's a lot of people that have charities named as beneficiaries. Mm-hmm. And as awesome as that is, and the benefit that will provide, in all those cases, the client or the individual has to die for that to occur. So they don't actually get to see the fruits of what they're donating. And so there's a lot of tools where they can begin to get benefit from that, donate while they're alive, and see the effect and the power that their gift provides. And so we'll get some education on how those can be structured.
Certainly. Okay. We should probably wrap up in the vein of trying to be concise. So anything else you want to add to this round?
I think we got it.
Okay. All right, everybody. Thanks for joining us, and we're looking forward to next time.
Thank you. See ya.